G'day guys, welcome to another episode of Invest with Tim Allen. I am Tim Allen, your fully licensed buyer's agent with IPS Buyer's Agents and your mortgage broker with Mortgage Finance Broker. I am today accompanied again with my colleague Ryan.
Hi everybody, I'm Ryan. I work for Mortgage Finance Broker. I've been with Tim now for 2 years and I've been a licensed mortgage broker for 7 years and a property investor since I was 27. So, wow, I don't want to tell you, I'm that's a long time.
Thank you for joining me today, Ryan. Today, what we're talking about is structuring for your investment property. So at the end of the day, and if you want to write this little nugget down, property investing is a game of finance. If you mess up your game of finance, you're not going to be able to invest very well. And when it comes to finance, structuring of that finance is really, really critical, because it can cause you positives and negatives. Right, you wanted to sort of talk to the people, and we've got some beautiful drawings in the background, which will
pull that video on. My artistic skills have come out again, so I'll do a walrus. Basically, there's two sort of tried and tested ways to purchase an investment property. The top one is called cross-collateralization, and it's not one that we like or we do very often. In fact, in the 7 years, I've done it once. And that was at the behest of the clients. And the bottom one is the better one because it protects you and gives you more power over the properties rather than a lender. And it allows you more freedom if you ever needed to sell one of the properties. So in both scenarios, we've got two houses worth $500,000 each. Total lending is $800,000. So for example, you're living in this house, it's your property, you're down to owing $280,000. So well done you, you've paid it down, excellent work. So if you went to if you went to a bank direct, they don't talk about this stuff. If you said I want to buy an investment property, they'll just put everything on the contract, bulk it all together, and they'll structure it like this. So they'll say, okay, the total lending is $800,000 and the properties are worth $1 million in total. So that's 80% of the total property value. That they'll give you two separate loans, but take the security of both properties and link them together. So if in the event you'd have an unoccupied loan of $280,000 and an investment loan of $520,000, so the extra $20,000 covers your purchase costs of stamp duty, solicitors, and things like that. So that's all tax deductible, which you would need to talk to your accountant about. But that's why we do this, because it makes life easy for your accountant, and your accountant will thank you, and then in turn he will thank us for doing it this way. So, if for example you wanted to sell this property down the track, you only have $280,000. But you've got $520,000 owing in this one, the bank has the power, because they've got the both properties secured against the loans, to say, well, okay, you might sell this for $600,000 and have hypothetically $320,000 left over, but they might say, well, because this one's still only at $500,000, we need you to pay this loan down by $120,000. And that extra money you would have had available from the sale of this property now has to come and bust it here and give you less money to buy the next property that you're looking for, if you're looking for an upgrade of your home or something like that. So this gives the bank more power over your properties, and it's not one we like.
So the structure up the top here that we're sort of talking about is a banker's best friend. They get all this extra credit with minimizing their risk to the nth degree. The other thing too is they will sort of talk to you, and they'll sell it to you in a positive way and go, oh, look, we'll only give you two loan splits, one for your investment property and one for your owner occupier. And it'll make it nice and easy. You only have to worry about two splits. There'll be nothing complicated about it, and happy days. Nothing to stress about.
Many clients struggle having more than one, two, or three loans because it can get complex and convoluted, but that's in the bank's favor, not yours.
Yeah. And when you draw it out, it becomes nice and simple. The method that we both prefer is down here, where we keep both securities separate and independent of each other. The other good thing is we could potentially take this loan here and this property to Bank A, and we could take this loan over here to Bank B. Then again, this could be with Bank A and this could be with Bank A. But there's, their own little bubbles in a sense, or their own pieces of paper in a sense on each side.
So with example one, that will be one application to the bank. With this example, it would be two. So we would submit this one as a standalone secured by this house with two loans, and then we would submit this one at the same time with this property and this loan. So this one is an 80% lend, $400,000 or $500,000 purchase, this is the same owner-occupied loan that you had of 280, but then there's an equity release of 100,000 to be 20%, and then the cost, the extra 20,000 that was covered before with the stamp duty and so on. But again, all of this will be tax deductible and will be separate. So your accountant will thank you, it's all there. This is all tax deductible as well, but this one isn't. Whereas if you have everything mixed, it can get messy.
So basically, in a nutshell, what we're doing is we're just drawing a little bit of a red ring around this one. And because the primary purpose of these funds here was for the purchase of your new property, both through the extra 100,000 that we need to get to the 500K, plus the 20,000 in purchasing costs, because that is what it's for, you can use that as a tax deduction, even though it's secured by your own occupier. Bernie, my accountant, he's been on a couple of episodes that we've seen in the past. We've spoken about this in the past on that. We'll probably talk a little bit more. Once again, talk to your accountant for that more specific advice. But by having that as a structure and the purpose of the loan being for an investment property, you can deduct that interest. Once again, you do need to have that conversation with your accountant.
Yeah, minimum licensed accountants.
Yeah.
But this is exactly the same result in terms of the lending. The difference is how it's structured, and if for whatever reason, say for example, you decide to sell this, this is completely separate. Bank has no power over that, and vice versa. Whereas, yeah, when it's all locked together, it minimises your ability.
So once again, using Ryan's example from the earlier one, that you sell this one here for 600. If you sell this property for 600,000, the only two loans that you have to repay is the 280 and the 120. Okay. You don't have to pay down that 400,000 anymore or anything like that. Now, if the values go up in 5 years' time and you come back to Ryan and myself and you have a bit of a chat to us and you want to look at restructuring things, we could, so long as the value of your home has gone up high enough and there's enough equity in the property to keep us below 80% loan to value ratio, we can potentially move this loan, which is attached to your owner occupier, across to your investment property, because that was the primary purpose for that loan. It was an investment purchase and it was for those things. The other reason why it's against this property is to keep it below 80% so you don't have to pay lender's mortgage insurance or LMI.
Exactly. That's precisely what I did. When we bought our new house, we got equity out to buy a new house. It was reversed because we returned our old house in an investment. And then 18 months later, we bought just before the boom, fortunately. And then I was able to bring this loan across to here. And then I've got 2 houses, 2 loans. Nice and easy.
Nice and simple. So once again, property investment is a game of finance. Understanding how to play that game of finance can set you up with a fantastic structure to look at moving forward. So, if you want to talk to experienced mortgage brokers who actually do invest, do understand this structuring system, because we both run with the structuring and everything like that.
And the key factor is we're working for you for the best result for you. That's the difference.
Please reach out to either one of us. I've been Tim from IPS Buyers Agents and Moreton Bay Finance Broker.
And I'm Ryan from Moreton Bay Finance Broker.
Thanks, guys. See you next time.